Good morning, everyone. My name is Stephen Liu. I'm the head of content and community at OnFrontiers. OnFrontiers is a peer-to-peer knowledge platform which connects knowledge seekers with industry experts and thought leaders around the world. Our service helps organizations explore new markets, make better decisions, and expand their impact. Today we have two of our featured experts, Baba and Wale, who have agreed to give a webinar presentation on investment opportunities in Nigeria. At the end of their presentation, we're going to allot some time for Q&A. Now, without further delay, here's Baba and Wale of AO Advisors.
So I guess just in terms of an overview, we're going to give you a quick and brief discussion of the Nigerian economy and of what, quote unquote, we're seeing on the ground in terms of opportunities, specifically in the credit space, but also we can talk more generally as well. And from after that overview, we'll have Wale give some local color as to what's going on right now, and then we'll just open up the floor for questions and go from there. So next slide, please. Talking about the Nigerian economy, you're talking about the largest economy in Africa, which is now going through a recession, the first recession in 25 years. In terms of prior to this, what we had was a lot of natural resource-driven growth with the average price of oil in the 90s, a situation where you had GDP per capita almost doubling over the last 10 years and GDP growth averaging 6%. Unfortunately, all of this was underpinned by an economy where oil accounts for close to 90% of US dollar exports and is roughly 75% of federal government revenues. In the first half of 2016, the Nigerian economy contracted for the first time with a 2.2 negative growth rate. And this impact on oil prices has flowed through the economy. With that said, going to the next slide. We are looking at a situation and an economy that has a tremendous amount of opportunities, especially in both the credit and equity side of the picture, but we are going to focus on credit because a private equity discussion about Nigeria has been disseminated across the board. But people seem to ignore the tremendous opportunity in credit. Nigeria is basically a $400 billion economy, $500 billion economy, depending on when you measure it, with a $75 to $100 billion banking system. Of every dollar in that banking system, in terms of leverage, a quarter to 30% is focused on oil and gas. This is despite the fact that oil and gas contributes 11% of Nigerian GDP. So you're looking at a situation now with the crash in commodity prices where you're going to need, and what we particularly call the great reallocation of assets away from oil and gas, away from kind of extractive industries to other parts of the Nigerian economy. At the same time, you have a situation where you have some Nigerian banks that are so levered to oil and gas, they have 40% of their loan book in oil and gas. That's not a sustainable situation. It's not sustainable from an NPL perspective, where you're going to see increasing NPLs in that industry, especially among the weakened players, and it's not sustainable from a macroeconomic perspective as well. But what this does mean, though, is that there is a unique opportunity for investors to acquire certain assets on the cheap, to provide liquidity to a banking system that needs dollars and needs liquidity, and to get above market compensation while doing so. At the same time, away from the banking system and kind of the assets on bank balance sheets that either they're willing to sell at a discount or that require, quote unquote, workouts, or shall we say some kind of distressed style investing, away from the performing loans. You also have, in terms of Nigerian family-owned businesses that are the backbone of the economy, especially the medium-sized industries that do anywhere from $5, 10, 15, $20 million in revenue. These businesses need expansion capital to grow. And the banks aren't providing this because they're dealing with their own issues. And they're really looking to mezzanine-style investors to fill the gap. And why does this work? It works because you have a situation where family-owned businesses will not dilute their equity. They can partner with the right kind of long-term investor. They can focus on assets that generate income. For investors, you can get above market yield. You can get dollar-denominated assets. And you are participating directly in growing aspects or growing sectors of the Nigerian economy. Next slide. Next slide. So, giving you that overview, what are the current options for credit investors in Nigeria right now? And we're just going to breeze through these pretty quickly. But in terms of kind of the basic option that everyone knows, these are your Eurobonds, your sovereign Eurobonds to start, really just you have the Nigerian dollar-denominated Eurobond sovereign that trades in London and in New York. Nigeria is very underlevered as a percentage of debt to GDP. I think the most recent number is roughly around 20%. And you're looking at a situation where investors can probably get compensated in dollar terms a yield in closer to like 7 to 7.5% at this point in time. Scrolling down, you also have your quasi-sovereign bonds as well. Next slide, please. Where you're kind of looking at whether it's the corporates or the bilaterals, if you will. You're looking at a situation where you can invest in companies that have some kind of pseudo government backing, if you will, or they're government parastatal, and you're kind of getting the next best thing to a sovereign. In that case, you're probably taking a little bit more risk, but also hopefully getting some more reward for those options. Next slide, please. Yeah. So when talking about the quasi-sovereigns, one of the interesting things we've noted is that a lot of this debt, while some of it is in bond form, some of it has actually been issued in bank loan bilateral form as well. So you can actually have, for the right investors who don't mind a little bit more illiquidity, you're looking at a situation where you have loans that are dollar denominated, that are pari passu. They're normally held on bank balance sheets, and because they're floating rate assets, they have a lower duration versus the sovereign bond, and that you might even actually be able to get a better illiquidity yield premium versus those bonds as well. So we've been able to source some of these transactions as part of our work, and we find that there's a subset of investors who might be interested, and we think like sophisticated investors and investors who are willing to kind of take a look across the whole credit spectrum should pay more attention to these than they have been, because there's a chance that you can source this paper and you can also get some very interesting yield plays as a result. Next slide, please. Going further down the credit allocation spectrum, and we spoke about this a little bit, one of the interesting aspects of the Nigerian economy is that there is a robust local dollar-denominated bank debt market. In that market, clearly there's overexposure to oil and gas. But at the same time, you're looking at a scenario and a situation where, especially as banks need and require liquidity, especially in the context of the Nigerian economy, that they will be willing to move some of these assets off of their balance sheet at some sort of discount. We have won mandates for multiple portfolios totaling the hundreds of millions of dollars that we are currently working on that are a perfect illustration of this. And not just in the oil and gas, but also in the industrial sectors and the FMCG sector as well. And we think that's going to continue because our belief is that the alternative capital providers and the alternative capital provision in the Nigerian economy is just starting. The economy is too large to be serviced by the banks alone, and over time we're going to see the creation, if you will, of both local and an international credit provider that can support the opportunities there, provide those dollars, and if you will, secure those dollars and help to create a continued credit culture in that economy. Next slide, please. When you think about the characteristics of local Nigerian bank debt and why it could be interesting to investors, you're usually looking at a 3 to 7 year max tenure. Usually the sweet spot's right around 5 years. In terms of the industry profiles, we've spoken a lot about oil and gas. It's usually reserve-backed lending, backed by producing barrels in the ground. Sometimes you also have growth capex and collateral lending for downstream E&P and midstream. Locally, in-country context, in terms of the dollar loans, you're usually looking at 9 to 11% all-in, or right around 5 years for producing assets. So focusing on real estate loans, what we could usually see are development loans and collateralized financings for marquee projects like the landmark project in Lagos, which was anchored by a mixed-use property and a Hard Rock Cafe. Usually these are dollar-denominated loans that are in the high single digits. They have some amortization, and usually probably for right around a 5 year term. Finally, the other large component of Nigerian bank loans that we see usually multinational subsidiary debt, usually in the consumer goods space. So here you'll have a Procter & Gamble, a Cadbury, or a Kraft helping to guarantee dollar-denominated loans to your local Nigerian subsidiary. They usually have a longer tenor than the oil and gas and real estate loans in that they're close to that 7-year tenor than the 5-year that we know. And you're usually looking at pricing in the LIBOR plus 5 to LIBOR plus 700 range, mainly because they usually have that international, multinational corporation guarantee. Next slide, please. The other very interesting part of the Nigerian credit markets that's becoming quite interesting, if you will, is the mezzanine market. We continue to see the tremendous interest from investors both domestically and abroad. And mezzanine funding, as we well know, is a junior part of the capital structure. It can comprise anywhere from 10 to 40% of a company's capital structure. Usual sizing that we see, especially for medium-sized industries in Nigeria, is probably right around the $5 to $20 million range, with return targets usually in the 15 to 20% range. How these returns are achieved is usually a combination of a coupon that's in the low to mid double digits, kind of similar to Nigerian bank coupons, but then usually the application of PIK interest or some kind of equity kicker. The reason why mezzanine debt, which has been popular in other regions around the world, is actually becoming quite popular in Nigeria, is because it allows usually these family-owned businesses to avoid equity dilution. It gives, depending on how it can be structured, it can be highly customizable to allow for extended drawdowns, and also in some cases interest holidays where possible, depending on the profile and where the business is in its life cycle, and it also allows for prepayments as well that can be agreed on ahead of time. The most established mezzanine market in Africa is in South Africa, which has a host of local players, but the Nigerian market continues to grow at double digits, and we continue to see some precedent-setting local transactions, including an investment by Vantage out of South Africa into Nigeria's Landmark Africa project, which is a real estate mezzanine investment. And Convergence Partners also invested into Venture Garden Nigeria, which was an incubator of B2B focused technology companies. And that was also, in both cases, the ticket sizes were right around that $20 million sweet spot we've been talking about. Next slide, please. Continuing our kind of talking about the structure around mezzanine credit, it's usually kind of 4 to 7 year max tenor. Obviously, oil and gas is going to be a big part when you look at the Nigerian economy. But real estate, surprisingly enough, and I know that developed market investors don't think of real estate as kind of an industry for credit investors, if you will. But especially in Africa, you can get strong security, and especially in Nigeria, strong security packages secured by producing assets with collateral and LTV ratios in the 50 to 70% range that can be used as collateral for mezzanine lending against new developments, or perhaps even existing but uncompleted developments. So this is why it's suddenly become an option for sophisticated credit investors in Africa looking for secured lending opportunities, because you have producing collateral, you have strong collateral that can be independently valued, you can ring fence the collateral in a security package, and you can lend against it, especially when you regard the dearth of Class A commercial real estate in Nigeria, in Ghana, to a lesser extent in Kenya and in Eastern Africa. It's a growing, booming sector of the economy that exhibits almost like a natural growth rate. So that's why, especially when you think about in terms of like the sub-Saharan African credit playbook, it's become a very interesting sector that credit investors focus on. Other industries, of course, include B2B technology, as we've spoken about, healthcare, education, hard lines, industrials, and power generation, especially in Nigeria, as independent power projects continue to come online every day. Next slide, please. In conclusion, We've just given you a brief overview of what we consider to be the massive credit opportunities in what is a $400 billion economy. We are happy to answer your questions. We'd love to talk some more about what we're seeing on the ground. But as we were discussing this prior to coming online, we believe that you are looking at a once-in-a-generation opportunity in Nigeria specifically, with the oil crash and with the restructuring and the reallocation of assets in the economy. Whether it is buying assets off of performing assets off of bank balance sheets, helping to work out not performing assets off of bank balance sheets, or participating as a mezzanine lender in the growing parts of the economy, there are tremendous opportunities for the right investors. Clearly, there are risks too. The ones that come to mind include FX. We do have some security issues, but those are being worked through both in the north and in the south of the country. Infrastructure provision still continues to be an issue. But at the same time, these are all opportunities for intrepid investors. And we think that the story and the diversification of the economy means that you can participate both on the equity front, and also we really believe that the opportunity is there on the credit front as well. And especially at this point in time where your dollars will go further, where there is a need for this liquidity, we think it's worth investors taking a very strong, careful but strong look at Nigeria. So with that said, and with that brief discussion, we are happy to open up the floor to questions. And Wale and I are happy to share our insights as needed. Thank you very much for your time.
Okay, so we're opening the floor up for questions. If you want to ask a question, you can type the questions into the tab that says questions. Or if we don't have questions right now, we actually do have some questions queued up for you, Baba and Wale, if you don't mind. So based on your discussion about the Nigerian market, and we talked a lot about credit financing, can we discuss specifically which industry verticals are more in need of banking services right now versus other ones?
Wale, do you want to start with the local color, and then I can go from there?
Yeah. So, well, when you talk about industry verticals in need, there are two ways to look at that, right? Everybody's actually going to say that they're in need, but then who really has the opportunity to be able to pay you back? Obviously, the biggest concern that you have in Nigeria now is the FX risk. The availability of dollars in the banking system is quite limited. The central bank isn't not selling as much dollars into the system. So even as investors do come in, the bigger issue is how do they get their money out. So with that being said, when you are invested in any industry, you want to look at an industry that hedges that risk hedges the FX risk for you. And the only way to do that is to be able to go into an industry that would be producing FX revenue. Now, obviously, the one that comes to mind, the most apparent one would be the oil and gas industry. But as we've said already, that has its limitations as credit has been overly extended to that industry, and it's probably the cause of the liquidity crisis in Nigeria at the moment. One of the less talked about industries would be the agriculture industry, and we're quite bullish on that, in the sense that the naira has obviously been revalued. It's now cheaper. Our exports are now cheaper. So you read a number of articles that actually a lot of experts actually believe that the naira has been overvalued in the past by up to about 40%. That has now been restructured in a sense, because right now the naira was about in 2014, in about November 2014, the naira was trading to the dollar at about $160 to a naira, to 160 naira to a dollar. Right now, the official rate at the bank at the CBN is about 3.15 to a dollar, so that's obviously doubled. And the black market rate as we speak today has gone up to about 490. So you have a situation where our exports are almost 3 times cheaper than they were just less than 2 years ago. So one of the most apparent one for me, I mean, the less risky one would be going into an export-based business, which we have a lot of them in the north, who actually produce cash crops and do sell those off, or actually have a bit of processing involved in that area where they do sell semi-processed goods. They do export semi-processed goods. Now, obviously, there are issues around finding the right sort of company to invest in or to give credit lines to for that. But obviously, that is where I think your dollars would go further, and the risk of you being exposed to the foreign exchange what's it called, oscillation would be limited. So in short, the answer I would give would be the export industry, specifically the agricultural cash crops or processed export industry. For that, Stephen.
Just piggybacking on that, from our perspective, what you're going to see, and we actually believe agriculture is going to be a big proportion of the great reallocation of credit assets. You're also going to think, I also think you should be able to focus on light manufacturing, on independent power projects, on consumer goods. The most recent transaction, private equity transaction done in Nigeria, was in consumer goods, which was Bilateral biscuits. And then I think over time, looking at alternative financial producers, alternative financial capital providers, and real estate will continue to be areas of interest.
And we actually do have another question about, I think specifically, there's been a transition from publicly owned power sector in Nigeria to more a privately operated sector. Can you comment on this transition and how it's been impacted by the financing challenges and some like the FX risks, as you said?
Yeah, so you have a variety of reasons for kind of the transition not working out like it should. I mean, the biggest issue, of course, is that you had a very, very old infrastructure and a creaky national grid. So even if you generate a tremendous amount of power, you still have transmission issues. Combining that with the fact that Nigeria is also trying to effect at the same time a move from a hydro-dependent economy and a diesel generator-dependent economy to a gas-fired, if you will, power economy means that there needs to be concurrent investments in gas distribution, gas extraction, and gas transportation across the economy that kind of are being that's hard to effect with the current fiscal situation and the current FX situation. You also have a situation where gas is not really market priced. So we still need to get to a point where gas prices are competitive with global prices, and that will also allow the coming online, if you will, of these gas supporting assets. So the DISCOs, the GENCOs, you're looking at a situation where you're not necessarily, you're still seeing a lot of leakage. Consumers are still adapting to marketplace prices. With that said, there are pockets of confidence with regards to IPPs, with regards to embedded generation, with regards to the DISCOs in the larger, richer cities like Lagos and in the Southwest. And those are going to be profitable investments. We also think very carefully selected independent power projects will be profitable as well, like Azura, among others. And we think renewable energy is also a big sector that people are now focusing on, specifically solar, which we think can also allow people to generate embedded power. Wale also has some color on biomass and other power options that will be coming online.
Yeah, I mean the real issue with the privatization of the power sector in Nigeria was a classic, a classic case of overvaluation of assets. So, the government did sell a number of these assets to private individuals. There should have been a proper audit that should have been done of the assets on ground. A number of those were assets where that were so dilapidated that the discos and to a smaller extent the gencos couldn't actually work with and had to pour in some more money into. You take that with the fact that the gas distribution network in Nigeria is actually really poor, and our over reliance on hydropower obviously has limited the effect that the privatization should have had on that sector. What we have is a situation where we actually, ironically enough, generate more power during the rainy season than at any other time during the year. And that's just because, the rains pour, and then obviously that affects the hydro, and then we're able to generate more power just because of natural causes. Once the rainy season is over, the water levels do come down, and obviously the turbulence from that and the power they're able to get from that is actually quite limited. So yes, the investment in there was primarily overvalued. The assets were not as good as investors originally thought. But having said that, they've still been given an opportunity to raise prices and raise tariffs, which the government has allowed them to, which they didn't let them do previously, and then they're able to recoup some of those profits. Also, adding on to that is as Baba touched on, is the IPPs and the embedded generation opportunities that do exist in places like Lagos, in places like Abuja, in places like Port Harcourt, and a few others. That's where we do see less risk for an outside investor. We do believe a lot of those are captive markets because you sell the power to either factories or housing estates or those sort of institutions, and you're able to sell any excess that you do generate to the national grid. That is sort of diversifying your risk, and we think in the future more people are going to look at that. A number of IPPs have been set up and have been quite successful, and we have others actually coming on board in the not too distant future.
Okay, perfect. Actually, we do have a question from one of the attendees. Mateus asks, my question follows up on the FX mention. Nigeria's central bank on August of this year issued a directive that reduced the amount of remittances of companies and create some barriers to remittance. The country went in a different direction from the region, and the spillover of the measures are not all desirable. Is there expectation for this to change, or the central bank lacks in its directives relative to FX?
Sorry, Stephen. Can you just mention that again? I think I missed you. I missed parts of that.
Okay, so
the CBN.
So we're talking about Nigeria's central bank and how they issued a directive to reduce the amount of remittances for companies, and they also created some barriers to remittances. And so the country went in a different direction from the region, and the spillover of the measures are not all desirable, like creating the black market. Is there expectation for this to change, or is the central bank just lax in its directives relative to FX?
Okay, so with the central bank, I mean, the major issue that they have, or that they had, and they currently still have, is the fact that there's no liquidity. They don't actually have enough dollars to fund to fund the country, right? So we're going from a situation where you need to fund about $4 billion a month or something for the CBN to fund the demand. The CBN wasn't able to get that, and what they've tried to do is put measures in place. So during June, July, and August this year, what the CBN actually did was to limit that just to be able to stabilize the demand that they had. They had a backlog of about $3.2 billion of unremitted funds that were trapped in the country. So what they did was they now issued directives trying to stabilize that and plan that out going into the future. What they then did on the back of that was to open a derivatives market, right, where you're able to now have futures and forwards, and you're able to buy futures of dollars up to 1 year in advance. They're basically options for you to buy dollars in the future. So you have maturities that go from 1 month, 30 days to about 12 months. And what they did was they basically brought down a 12-month future from today is probably priced at about 230 naira to the dollar, while if you wanted to get that at the central bank rate today, that's about 310. So what they hoped to do was to say, all right, okay, if you're able to get more money for more dollars for your naira in the future, you probably postpone the demand that you have for the dollars today, and that was the idea. Now, whether that has worked fully or not is open to debate, because at the end of the day, the CBN hasn't still been able to get the required dollar liquidity that they would need to fund that structure. I don't think they're going to be able to change anything now. They did have a readjustment in September where the futures prices for Naira did go up, and what I mean by that is, if a futures price for 6 months, a 6 month future for a dollar was about say about 270, it went up from 270 to 280, so they readjusted that to also be more realistic in the valuation of the Naira. Now, if they're going to be able to carry that on, they still need to get more dollars into the country, which at this point they haven't been able to do. So the question is, they have given you different options, and they are trying to find a way to draw in more dollars into the country, and whether they'll be successful with that or not is open to debate. But you do have things coming on board, like a reduction in the pipeline vandalism that has been going on. This new OPEC meeting that just happened, where they've actually agreed to regulate the output, might actually increase the price of oil. We don't know. If that happens, that would also have a positive effect. And they are looking at getting a loan from the Bank of Japan and China, about a $3 billion. I'm not actually sure the exact amount. That hasn't been published yet. But if more liquidity comes in, that would actually certainly help the structure they're trying to impose.
Just piggybacking on the back of that question, there was also, with regards to that specific remittance policy, the CBN. There's been discussion that CBN has relented, because they just went from having a significant number of remittance providers in the system to almost giving a monopoly to some of the more established providers, and there was an uproar about that. So the indications are that we still haven't seen anything official, but they're studying the opportunity to kind of add back some new remittance providers into the marketplace. The issue, really, when you think about it, is that the CBN believes that it owns all dollars in the system once they come into Nigeria. So that's really kind of the issue, and the CBN does not believe that, and it has not seen all of the dollars in that system come in, and on an official basis. Whether you agree with that or not, whether you have more libertarian tendencies or not than I do, the CBN is literally trying to control as many dollars as it can, and that was really the basis of what we believe was a slightly short-sighted, short-term policy. We still think that the best approach will be to harmonize both the official rate and the black market rate. And as we have been discussing, we really do not believe that the black market is that deep. Wale has mentioned in the past that 100 million flowing into the black market can affect the black market rate significantly, and we think there's more than 100 million of a day demand for FX in Nigeria. But the CBN, for all intents and purposes, is trying to do whatever it can to control dollars at the official remittance rate and try to avoid a widening or blowing out of the currency. Whether they will be successful against market rates remains to be seen. We can only point to what we have seen in other countries where we believe the best thing with regards to devaluation, especially a commodity shock-induced devaluation, is to take your medicine early and quickly.
Okay, so let's talk about. I think we delved into this one in our last conversation, but we talked about some of the foreign direct investments coming into Nigeria in spite of all the challenges that we're facing in terms of FX, in terms of the banking liquidity, and even like the social and political unrest. So can you highlight some of the sectors that's really been seeing a lot of foreign interest and maybe explain why, that is?
No, definitely. I'll actually pass this on to Wale because we just spoke about a transaction of Biloxi that's in the FMCG space. Wale is very close to that space. He handles those relationships and he knows that industry intimately in Nigeria. So I'd love him to talk about it as a bit of a case study as to how people are thinking about investing in Nigeria right now.
Sorry, I muted myself. As Baba said, what we have seen is, the fundamentals in Nigeria haven't changed, right? So, we are still the largest population in Africa. We do still have 170 million people. We still have, we still do have the largest economy, even though that's been quickly eroded. So the fundamentals haven't changed. The 170 million people in Nigeria still have to eat every day. And that's why, the FMCG market is always going to be buoyant. It might not be as big as it was, in the 2012, 2011, 2013 space. But, it's still a very attractive market, and there's still a lot of value to be had to be received in that market. As Baba touched on, we have gotten investments this year for Biloxi. They raised about $80 million, and they're primarily a cream crackers production company. And they've been able to get in some big hitters. ACA, DEG invested in them. Into that space, and there's still some under the radar FMCG companies that still actually do get that do get the investments. Like I said, the fundamentals haven't changed. The Nigerian people still have to eat. We also got, I think last year, was it Baba, where Chi also got an infusion of about $240 million from, I think, Coca-Cola also. So we do still see a lot of investments still going into that FMCG space. Less than, well, the biggest foreign direct investment still obviously goes to the oil and gas space, but then the FMCG space has been quite strong, and even it's very, very interesting that even in a time of recession like this, we do still see some activity in that area. The real estate market also is also attracting a lot of investments because obviously it's now cheaper. The properties down here are now cheaper because of the devaluation in the naira. A lot of these properties are actually rented out at using dollars and being paid for using dollars. So there's not as much of a risk in there, and your investment is a lot lower. So there are those pockets of industries that still do attract foreign direct investments, and will still do so throughout this recession period. And the guys who actually come in at a good price at a good time, like now, get these assets for cheap and reap the rewards.
So just piggybacking on that, I mean, the way to think about it is that we're seeing investments not just from financial investors, but also from strategic investors as well. The Chivita investment was clearly a strategic investment by Coca-Cola. Bilateral was more of a financial investment. In the oil and gas space, we continue to see investments from both local majors, local champions, and the internationals, even though the internationals and the IOCs are focused more on offshore versus onshore. Um, in real estate, as we've mentioned, we're also seeing a tremendous amount of interest, especially in mixed-use developments. Something usually some kind of residential or lodging investments anchored by retail or commercial. So you're starting to see an increase, continuing increase in Nigerian malls, if you will, and Nigerian hotels. Lagos and Abuja continue to have a paucity of world-class hotel rooms, and so we continue to see multiple hotel development projects come across our path. Again, those are of interest to mezzanine investors and also to senior bank investors as well. Also, on the smaller side, we continue to see some in the nascent tech sector, some investments there, also seeing investments in healthcare. And primarily, I think the focus for investors now, especially as Nigeria is going through a recession, is to focus on defensive style industries, whether it's fast-moving consumer goods, whether it's healthcare staples, to a lesser extent, education. And then, of course, you also have the traditional Nigerian or foreign EMP-based investors going to continue to look at those assets out of Nigeria, both from the banks, both in terms of credit, both in terms of equity, and also in terms of buying direct physical assets as well.
Okay, perfect. So we're hitting the 11:50 mark. We're going to wrap this up quickly. Just as a final thought, let's say for an investor looking to get into the Nigerian marketplace, what would you recommend is the best way for them to research opportunities or to, discover the specific sectors in which they can, their money goes the longest? Um, I mean, specific to, potentially like doing market research or, getting in touch with experts such as yourself.
I mean, from our perspective, I think we're on the OnFrontiers platform. We think it's a great platform to use to reach out to market experts like ourselves, and also just leveraging OnFrontiers network. At the same time, working with AO directly allows you to leverage an in-country network with our managing partner Wale on the ground in Lagos, across Nigerian industry, across multiple industries, and also across government relations. We also do a variety of thought pieces as well on not just the credit markets, but also on Nigerian investments in general. We have a blog where we continue to kind of put our thoughts out on LinkedIn and other forms of media. And we think that it's very important to start kind of like with a macro overview. But then, of course, you're going to need in-country knowledge. You're going to need expert knowledge. That's where the OnFrontiers platform comes along, and it's quite helpful to kind of have those discussions and kind of get even more in-depth knowledge. But then to supplement that, I think you need a partner like AO with people on the ground who can give you that local, on-the-ground, real-time color, and also walk you through the processes, do on-the-ground due diligence as needed, do on-the-ground analysis as needed, and kind of marry a Nigerian and sub-Saharan African mentality with Western training, with Western experience, with Western standards to kind of give you the best of all worlds.
Awesome. So I think that concludes the webinar. If there's any final questions, please type them into the tab now. But if you do have any follow-up questions that you didn't have an opportunity to ask, feel free to shoot me an email. I'll direct it to Baba and Wale. My email is sliu@onfrontiers.com. And yeah, so I'd like to thank Baba and Wale for their time. It's been a very informative webinar. I think we all learned a little bit something about Nigeria and the Nigerian markets. For future webinars, just stay tuned to Frontiers. If you subscribe to a newsletter, we're going to shoot out information about upcoming webinars and information sessions with our experts. We also publish an expert digest once every 2 weeks. Basically interviews with our experts in our network and some articles that they're writing about different marketplaces and market insights around the world. The website is www.onfrontiers.com, and we look forward to working with you guys in the future and definitely linking you with experts around the world. Thank you so much.
Thank you very much, Stephen. Appreciate it.
Take care.